All right, good morning, everyone. I am Ava Archibald, Principal in charge of our Wealth Transition Services of Eide Bailey, and I have Ramona Johnson, partner out of our Fargo office, who focuses in our Wealth Transition Services area as well, joining me today, and we're going to share with you the estate planning and what it looks like in today's current estate tax environment. So today, under our current laws, we have a 40% estate tax rate. We have an estate tax, gift and estate tax exemption of 11.58 million. And in 2021, that's going to be indexed for inflation to 11.7 million under the current law. This exemption is available for gift, estate, and generation skip planning, which means if we're transferring down, let's say, to grandchildren, the next generation. We have portability available, which I'll explain a little bit here in a few slides if you're not familiar with that term. We do have under the current law a sunset provision. So as of January 1 of 2026, that estate tax exemption, as we know it today at 11.58 million, is going to drop back down to 5 million adjusted for inflation. We think by the time we get to 2026, that is going to be somewhere around $6 million. We also have annual exclusions of $15,000 per person. That's in 2020 and 2021. That means I can transfer $15,000 per person and not have it use any part of my estate tax exemption. So I could give $15,000 to my son. My husband could give $15,000 to my son. So together we could transfer $30,000 of wealth without having it use any part of our exemption in a year. With the sunset provisions, concerns we've had with taxpayers is, well, that exemption, if I use my exemption today and it drops in the future, how will that look? And will I be almost penalized for using that larger exemption? The term we hear when people are talking about this is clawback. And the Treasury issued final regs in November of 19, which gave some comfort to clients to know that if they use the higher exemption now, and that exemption drops in 2026, there will not be a chance for the IRS to try to recoup the tax on that higher exemption used. So the estate tax exemption at death is computed using the higher of the applicable exemption used for gifts made during life or the applicable exemption at death. So if I die in 2026 and my exemption is 6 million, but today I used 11.58 million, I will not be penalized or charged tax on that difference. The other concern clients have is, how does it work if I want to use that bonus? So in 2026, if the estate tax exemption will drop to 6 million as we expect, and today it's at 11.5 million, how do I use that bonus, that 5.5 million, the difference between where we think it will be, 6, and the 11.5? If I use that $5.5 million bonus right now, does that still give me 6 million in 2026? And the answer is no. You use it from the bottom up, not the top down. So if I made a gift of 5.5 million today, when 2026 happens, I would only have $500,000 of exemption left. So remember that if you're thinking you want to take advantage of this increased exemption, you're using it from the bottom up. And with that thought, sometimes spouses are using an exemption of one spouse and leaving the other spouse to have their exemption in 2026. There's some planning we think about for our clients on how best to use that exemption. Today, we find ourselves in an environment that no one ever expected us to be in. With the COVID pandemic and the changes we've seen in this last year are something I don't know that any of us have experienced. We are in an environment where we have suppressed values to many of our closely held businesses due to the shutdowns and other economic issues that have been addressed this year. We have historic low interest rates. The rates just came out here for November, and I believe they're the lowest that I remember in my whole practice of 30 years. We have a government deficit, a massive bailout that has happened, and still discussion of maybe future benefits or bailouts on the horizon. Where does that put the government? There's a deficit, and how will this bailout or the future bailout be paid for? We have clients who now may be looking at making gifts or using this higher exemption they have available, but they're concerned about asset protection with this unknown environment we're in. We have some family members who are asking parents, if they're making a gift, to make sure that they're transferring it maybe to a trust to give their children some asset protection, just because we don't know of the unknown future. We have clients who are looking at making their larger exemption, but they want access to the cash flow because they don't know where our future may be. There are things we can do to let our clients use their higher exemption and keep the cash flow if needed. And the other thing that is unknown is the future adjustments to our estate tax exemption. In July, we had Biden and Sanders issue a unity task force recommendation. And in that document, they said that the estate taxes, they would look to raise those estate taxes to a historical norm, but they didn't define historical norm. So what does that mean for us in the future? Does that mean that our sunset provisions may be happening sooner than later? There are some that think because of these bailouts, maybe that will happen just to recoup some of that revenue for our government. There are democratic discussions in the political campaigns of talking about the estate and gift tax exemption to maybe drop as low as 3.5 million, and increasing that rate, which is currently 40%, to ranges of 50 to 55% and maybe even possibly higher. There's also been discussions about doing away with the stepped up tax basis. The benefit of having estate tax is that if you own assets at the time you die, when estate tax is in effect, we've always been given a stepped up tax basis to the assets when we die. Well, that's great. Let's say if we're, especially an example is a farmer who maybe doesn't reach that $23 million asset value between husband and wife, with the $11.5 million exemption to both of them, they would never owe estate tax. But the farmland they have, if they die with that land, they would get a stepped up tax basis to the date of death. So for my family farm, my dad inherited his family farm from gifts year after year since the 1930s. I'm hoping he just dies holding that land, and then our family will have a stepped up tax basis. That is a great benefit. It's been discussed that maybe doing away with that and lowering the estate tax exemption seems a reach for me, but you never know what will happen. I didn't think the estate tax would go away in 2010, and it did for a short time. So it's something we want to watch and keep our eyes open. The other discussions we're hearing from some national commentaries across the country, people are discussing that if a change does happen to the estate tax exemption, and it takes some time for the House and the Senate to pass a bill, maybe not until later in 2021, would they make that retroactive to January 1 of 2021? It's not unconstitutional for them to do so. It would be hard to plan for if they did, but it is a possibility and something we want to think about. So where does that leave us? That leaves us to think about the time is now to plan. Maybe you want to review your documents to make sure that they provide for portability and the flexibility that we may see in the estate tax exemption. We see many very well-drafted estate planning documents when we do our planning for clients. But as an accounting firm, we're looking at it from the tax perspective. Has anyone looked at your planning documents from that tax perspective recently? With portability, with the possible changes to the estate tax exemption, maybe it's time to review those planning documents, and do they still make sense, or do they need to be reviewed when you look at it from that tax perspective? If we have clients who want to use their higher exemption, this 11.5 million that's available, maybe we should look at having them position themselves to be ready to pull the trigger. I have some clients who are drafting trusts right now so that if it gets to be the end of the year and they think the exemption really is going to drop and go to a significant drop, they are ready and positioned to pull the trigger. If they want to use the higher exemption of 11.5 million, many times they don't want that much to go right out to their children. Or like I said, there's some children who want asset protection. They'd rather have that type of gift put in a trust. So some clients are getting those trusts in place, and they'll decide at the end of the year if they're going to pull the trigger, maybe do a stock transfer, maybe cash into that trust, but they're setting themselves up. I see this as deja vu of 2012, when we had an exemption of 5 million that dropped to 1 million. We had a lot of people at the end of that year scrambling, trying to decide how to use their $5 million exemption before it would drop to 1 million. I'm starting to see that now. People who have talked about using their higher estate tax exemption for maybe the last year or more are now moving forward and looking to use that exemption before we have a change. If you are looking to do that, make sure you have those discussions sooner than later. What we saw in 2012 was a rush at the end of the year, and it got to be a point where professionals just didn't have time to do all of the planning that people were looking to achieve. So if you are thinking you want to do that, have those discussions now with your advisors. With that, I'm going to now bring up portability. If you're not familiar with that term, that came about in 2012, where we have now the ability that the first spouse who passes away, if they don't use their exemption, they can make that portable or pass to their surviving spouse. There was no change with this, with tax reform, which was great because it is an added benefit to our clients. So portability is, again, that's if I die today with $11.5 million exemption and I don't use all of that on my death, my husband could file, or my personal representative, file an estate tax return and take my unused exemption and make it portable to him. So right now at 11.5 million, if I left everything to my husband, Jim, there's a free marital deduction. Anything I pass to my spouse is not subject to estate tax. So then Jim could have an estate tax return filed and receive my $11.5 million exemption. My exemption that passes to him is not adjusted for inflation, and his exemption remains the same. So if he dies in 2026, let's say, when the exemption drops to 6 million, he'll have my 11.5 million plus his 6 million. If he makes gifts after that 2026, he's going to use my 11.5 million first and then have his exemption. My exemption that is portable to him does not increase for inflation, but it is available to him. So what are the things we think about with portability? Well, simplicity. For some clients, it's very simple now. We can transfer everything to the spouse and my exemption transfers over to him. Well, that may make some sense to some clients. It all depends on what happens at the time of death. What is the age or the health of the surviving spouse? What assets do they have? Will they be appreciating in value, or will their value remain stable? Would it make sense for me to transfer everything to my husband, Jim, and we're in our 50s, he lives till he's in his 80s, 30 years down the road, it would be great to have my kids have a second stepped up tax basis. However, if we held, let's say, a closely held business interest that's appreciating rapidly, I might want to use my exemption today. So it's something we look at after death, and we have to weigh out what's the estate tax savings to the second stepped up tax basis. And it's a decision really you make after the death of the first spouse. It's a post-mortem planning that is looked at. I think of it as an after death planning tool. So you want to make sure your documents provide the flexibility that you can take a look at your situation when the first spouse dies and determine if you want to use portability or not. It also can be a benefit for state estate taxes. For me, I'm a resident of Minnesota, where the estate tax exemption is $3 million. So I may want to pass $3 million to my children to be sure I use my state estate tax exemption, because there are no states that provide portability for the state estate taxes. Not all states have estate taxes, but some do. And if you are in a state that have state estate taxes, that may make you change your decision on whether or not you want to use portability. For me, maybe I transfer $3 million to my children so I don't lose my Minnesota estate tax exemption, but the rest of it I want to make portable to Jim so I don't trigger any Minnesota tax that would be paid out of my pocket on that first death. The risks you have is you do have to file an estate tax return, and there's a cost to filing that return in the preparation of the return or getting valuations of assets, depending on what assets you hold at death. So you want to weigh out the tax savings to the cost. It does not pertain to generation skipping tax. So it is portable for gift and estate tax exclusion, but not if I'm going to skip a generation like to my grandchildren. Again, no states have adopted portability. It's just at the federal level. And the most important thing to remember, I think, is that the statute of limitations does not start running until the second spouse dies. So again, in my example, if I made my assets under my planning documents pass to my husband, Jim, and he picked up my estate tax exemption, but he lives for another 30 years. It's 30 years down the road that the IRS could look at that exemption he received from me, and they're going to be looking at my return 30 years down the road. For our mid-size estates, those clients that are right at that threshold of the estate tax exemption, that's really where you want to, I think, look at your planning documents. Before we had portability, many times there was a credit or a family trust set up so that the first spouse could use their exemption, transfer it to a spouse, give the income stream, or transfer the assets to a trust for the children and give the income stream to the spouse. So they would use that exemption of the first spouse, and then the balance would go outright to the spouse or maybe to a marital trust. These were known as credit trust and a marital trust, family trust, or a marital trust. Sometimes people refer to them as an AB trust. Well, now, does that still make sense? Some of those trust agreements don't leave you the flexibility if there is a change in the exemption. So these are the types of documents or estate planning documents you might want to review and see if they make sense. Maybe instead you'd want to consider leaving everything to your spouse and let your spouse decide if he wants anything to pass in trust to the kids. Sometimes that's referred to as a disclaimer trust. So in my situation, if I left everything to my husband, Jim, I'd let Jim decide after I die, does he want it in his own name or does he want to disclaim it? Say, I don't want it. And under my planning documents, it could go to a trust for my kids using my exemption at that time. A qualified terminal interest trust is something you might hear. These are trusts that you can create it as a marital trust, but after death, my husband could decide how much of that marital trust does he want taxed in the first estate, meaning my estate, or does he want that exemption to pass, the whole trust to pass to him as a marital deduction. Those are the type of techniques that leaves options on the table for our clients so that they can make that after death planning decision. For us as accountants, when we do planning, we're looking at the numbers and the tax. Again, we have very well drafted estate planning documents we see many times, but we take those documents and we try to put it into a very simple flow chart for our clients to say, here's your total net worth. Here's what your tax may be on the first death. How do we want the assets to transfer on that first death? Here's some tax that may or may not happen on the second death, and how does it pass to the children? That's what we illustrate for our clients. And I think it helps our clients understand what do their documents, how do their estates really play out based on their current documents. In the unknown future that we have with this election we have, with the COVID pandemic, our exemption might be changing. There's certain planning ideas that work better for this unknown future. One of them you might want to think about are interfamily loans. This is an easy way to use exemption if it appears the exemption would be reduced. If I made a loan to my children the interest rates are low, I'd take a low interest rate back on a promissory note. And if I decided I wanted to use my exemption, that's a really easy way. I could just forgive a loan. A spousal access trust is a way I could transfer assets to a trust for my children, but give the income stream to my spouse. That would allow me not to lose the cash flow. As long as I'm still married to my husband, Jim, if I transferred assets to a trust where Jim gets the income stream for life, the balance goes to my children. As long as Jim and I are married, I still have the cash flow. It's a great way to use the exemption, but not lose my cash flow. Other things are sales to a defective trust. That's an irrevocable trust that one may set up, but yet still have language in the trust agreement that even though I make a gift to the trust, it's written in a manner that I'm still subject to the income tax. I'm paying the income tax on that trust. That way I could sell assets to the trust and take back a promissory note. This allows me to use a small amount of exemption initially, but gives me the ability to take back that note and that promissory note. I have cash flow coming back to me with that promissory note, but if I don't need it or I want to use my exemption, I forgive the note. Ramon is going to get into a little more detail in regard to this technique, but it's one we see often at this time. Another step that Ramon is going to share is about defined value clauses, because when we saw what we saw happen in 2012 is people at last minute were making gifts, but maybe they didn't have time to get the business valuation of their company, or they were gifting real estate, but they couldn't find an appraiser to do an appraisal before year end. We can make transfers based on a certain dollar amount. Maybe I want to transfer $11 million of assets before year end, but I'm going to use corporate stock, but I don't know how many shares of stock that would be. Not necessarily 300 shares of stock, more $11 million of assets. After I get the business valuation, we can determine how much stock. Defined value clauses allows you to do the transfer documents based on a dollar value. And it provides a means to transfer assets quickly without waiting for valuations, or if you have difficult assets to value, you can still move ahead with the gift. Planning a low interest environment works very well for those interfamily loans, like I mentioned, maybe refinancing loans, the sales to the defective trust, where we transfer assets to a trust and take a promissory note back. We have a grant to retain annuity trust, which is very similar, except instead of taking a promissory note back, we take an annuity stream back. It also works well for charitable lead trusts. If we want to give assets to a trust and get a charitable benefit for a certain amount of time, and then at the end of that term, it would pass to other family members, maybe back to us, that works well. What doesn't work well are charitable remainder trusts, where I put assets in a trust that I get to benefit for a number of years, and then the charity gets the benefit at the end of that term. That income stream back to me doesn't work as well in a low interest environment. The same is true for a qualified personal residence trust. I transfer to a trust my residence to live in for a certain time frame, and then it passes to my children. That doesn't work as well in a low interest environment. Usually if we use those two techniques, there's some other reason we're using that. Now, about the refinancing of existing loans with the low interest rates that we have currently before us, we've seen a lot of clients who have taken advantage of this. So if they have loans between family members, loans between business entities or related business entities, they're restructuring these loans at the lower interest rate. If we do that, we want to ensure that there's a prepayment allowed under the current note. You may want to redefine your term, or keep on the same term and just lower your payment. You could pay interest up to the date, or refinance that interest and roll it into the new note. But whatever you do, you want to make sure that it really looks like a business transaction. We don't want it to be considered as a gift. So some concern and considerations we want to think about with that is, should there be a partial principal payment if we refinance a note between related parties? Should the interest rate be a little higher than the AFR? Or should a higher interest rate be triggered if there's a default. We want the loans to have a bona fide business, to be looked at as a bona fide business transaction. If I went out to the market and tried to go to an institution and a financial institution to get a loan, they may want some of these extra considerations put in place. Maybe we should do that if we're doing this with related parties, so it's not considered a gift. Things to consider. But if you do, make sure you provide flexibility. Interrelated loans, interfamily loans, have a prepayment clause. Maybe use an interest-only note with a balloon. Make sure you're tracking your payments, keep your adequate records. If you're paying the interest, make sure you're noting that that interest is paid and the payments, and make sure the borrower has the financial capacity to repay the loan. This, I think, has become more important in the last year because there's a current case that came out this year where we had a situation, which is typical for many families, where parents loan money to their children, and then over time, they maybe gift part of the principal or the interest part of that loan to their children using their annual exclusion or even using some of their exemption. We see that often between family members. In this case, this mother made gifts to her children and forgave balances over the years, which was fine, using her annual exclusion, and died many years later, had a balance left on the loan with one son, reported it on her estate tax return. She wasn't avoiding that. She had this receivable that was still due to her and an asset. But the IRS looked back to future years where in 1989, the son became insolvent. He wasn't able to pay on the loan. The mother worked it into her planning documents to account for this as like an equalization clause among children. And the IRS said that gift happened back in 1989, causing this family to pay significant tax because the exemption was much lower way back when. The thing you want to think about now that we see this case is, if I am doing loans to my children, do they have the financial wherewithal to make payment on that loan if needed? That's where an interest-only note is very beneficial, especially when we have a low interest rate. At least they could pay the interest on the loan. That way, it doesn't look like a gift. It is a structured business loan with the current interest rate. So the things the IRS are going to look at on that is evidence. Document it with a promissory note if you're loaning money to family members. Have an interest rate set. Maybe you have security or collateral, a fixed maturity date, track those payments, and is there the ability for the children to make payments on that note? So a lot of our clients that we work with have closely held business entities. And when we're doing our planning, we are looking at an overall plan. And what are the components of a successful plan when we're looking at a plan for a closely held business client? Well, we want to make sure we identify the owner's objectives and goals. Whenever we're looking at a wealth transition plan, we're looking at transitioning that wealth, either during life or at death. And if we took the tax off the table, we want to make sure whatever plan we come up with matches the owner's objectives and goals. If we're transitioning a business, we want to make sure that we quantify the business and the personal financial resources. Does it make sense if we're transitioning assets down to the next generation? If there's cash flow that needs to be adjusted, does it still make sense both from the business side and the personal side? If we're working with our clients that are looking to retire at some certain age or transition at a certain age, does the value of their company make sense or allow them to step out of the business at a certain time? It may be that we partner up with our business valuation group of Eide and look at, do we need to enhance the value of a business so that someone can transition or retire at a certain time? We want to make sure whatever plan we're doing can continue in the future and make sense for that second generation that's coming into the picture. There are times when we have a plan that we might transfer to family, or maybe it makes sense to look at third parties that the family might have to sell out of a business, or we're looking at a farm operation. Does it make sense to transfer this farm operation down to the next generation, or do we have to look at stepping out of that farm operation? There are many things we look at when doing our planning, from the personal wealth and the estate planning together. We want to preserve the wealth for the family and minimize the taxes. Again, we're always looking at planning from the tax perspective, whether that's lifetime or at death, using sometimes lifetime planning tools and death planning tools. When we do planning for our clients, we're looking at the immediate. What is the immediate effect if something happens? There's an unexpected death. What is the cost to the family? Let's be prepared for that, and then let's plan for the future. We want to make sure that those exit objectives that everyone is looking at works well, whether one lives or dies. And it's coordinating that business succession plan with the estate plan. We want to make sure this works for the family as a whole. So with that, I'm going to turn this over to Ramona, where she's going to share in a little more detail some of the techniques I touched on at a high level. She'll explain more on how those work so you can better understand how one can play that into your family picture.
Hello, everyone. Well, thank you, Ava, for all the information that you have shared already. And as Ava said, I'm going to dive a little bit deeper into some of the techniques that we have used for estate planning, and in particular, how the use of these techniques are maybe changed a little bit because of just the situation that we're in from a political and economical standpoint. Basically, the fact that the exemption may go down sooner than later. So we'll get into more detail on all of these trusts. The one thing maybe to start with is that the three types of trusts here that we have, they're all different, unique. They have their own individual characteristics, but the one thing that they have in common is that for income tax purposes, they're all treated as what we call grantor trusts. And for a grantor trust, that means that for income tax purposes, the grantor is still going to be taxed on the income earned by the trust. So if we have a brokerage account in one of these trusts, the grantor, the person creating the trust, is still going to be taxed on the income from that brokerage account. If it's a partnership or an S corporation, they're still going to receive the K-1 from that entity and have that income tax cost. And as we'll explain later, there are benefits from an estate tax perspective on doing that. And there can be benefits from an income tax standpoint too. But keep in mind that all three of these types of trusts are grantor trusts. The technique that I think will be used a lot if we are concerned about the exemption going down is the spousal access trust that Ava mentioned earlier. And basically, this is a trust that can be created. It's out of your estate for estate tax purposes, but the family household, the couple can still have access to cash flow from the assets. So basically, the grantor is transferring assets into a trust. That's a reportable gift. The spouse can be a beneficiary, can receive required distributions of income, or it can be discretionary distributions of income. This can all be determined or is determined in the trust agreement that's created. Keep in mind that this is an irrevocable trust. So once it is set up, you need to go into it looking at it like that can't be changed. Granted, states are changing the rules on that, so it is somewhat easier to make changes to a trust than it has been in the past, but I always tell clients to look at it as if you're not going to be able to change anything. Again, the spouse can have discretionary or required distributions. And then ultimately the children or whoever your beneficiaries are will become the owners of that trust. Like I said, it uses the spouse's exemption. The trust agreement will set out what rights there are to distributions. Depending on who the trustee is, may determine what type of distribution options you have. Sometimes it's going to be limited to health, education, maintenance, and support, which is the HEMS. And sometimes it can be a broad discretion if there is an independent trustee. One of the things to keep in mind is that the trust is not includable in the beneficiary's estate, the spouse's estate, and because of that, there's no step up in basis at death. So keep in mind that, you know, it's not getting step up on the first spouse's death, and it's not going to get step up on the second spouse's death. You can have each spouse creating trusts for the others. There are rules that you need to follow if you're going to do that. Basically, the trust can't be identical, and we'll cover that a little bit more in another slide. Some of the ways of creating these different trusts are powers of appointment might differ. That's the ability of a beneficiary to change how the assets are ultimately going to be distributed. So one spouse may have no powers of appointment, and one spouse may have a very limited power to change how assets are distributed to the children. You'll see a lot of estate plans, you know, even your revocable trusts or wills that include these powers of appointment. And they can be very beneficial in that we don't know how things are going to happen with our kids. We don't know, you know, if they might have creditor issues or things might change for them in the future. And so being able to change those provisions can be very helpful. You might want to create them in different states. Again, the distribution and termination terms could be different. One trust might be a generation skipping trust that's ultimately going to benefit grandchildren, and the other trust is not. One of the other things that we really like to see if both spouses are creating these trusts is to put some time between them, so that they're not being created on the same day. And we especially like it to be a few months, or even, you know, doing one now at the end of 2020 and the other one at the beginning of 2021. In 2012, when we went through this same possible scenario, you know, that wasn't always possible to put the time in between, but that would be the general rule, is we would like to see time between creating these trusts. And also maybe different assets. So it might be, you know, one closely held business in one trust and a brokerage account in the other trust. This slide is just an example. It's one that I used with a client back in 2012 when we were creating these SLAT trusts, and just what the different provisions could be. So like I said, I think the SLAT is going to be a technique that could be used a lot now, because for a lot of people, you know, using an $11 million, making an $11 million gift to use your exemption is not maybe economically feasible, but by doing the SLAT, you might be able to keep enough cash flow within the family. A couple other considerations is divorce. You know, we had a situation again back to 2012 where we commented on divorce, and, you know, not going to happen, very sound marriage. And between then and now, divorce has happened, and the depending on the terms of the trust will determine how that trust is handled after the divorce. So, you know, it needs to be a consideration if there are any marital issues that you need to consider. The next technique that I think will be used more often than the GRAT, which we're going to talk about in a minute, is the sale to the defective trust. And this is you'll see that all of these flow charts are kind of similar in that you're transferring assets into a trust. Again, it's a grant or trust for income tax purposes. In exchange for transferring that asset, you're getting a note back. So we have a gift element with this transaction, generally at least 10% of the total transaction. And then in exchange for the sale part of it, you're getting an installment note. Again, the assets are held in the trust during, the term of the trust. You'd want that trust to exist at least as long as the installment note is in existence. Because this is a grant or trust for income tax purposes, there's no income tax consequences with the sale. There's no gain that needs to be recognized, and the interest is not a reportable interest item. At the end of the trust term, or at the end of the, however the trust agreement is established, your trust beneficiaries are ultimately going to have that property, whether it continues in trust or not. How this can fit with our uncertain times right now is that, like I said, generally the general rule is that there's a 10% gift element. I have done transactions where we do more than 10% as the down payment, again, mainly so that we're using the exemption now, since we want to take advantage of that. The other option is to do the 10% gift and have the note, but then you could gift the note or a portion of the note if you think the exemption is going to go down. Some of the advantages and disadvantages of this trust: again, we can have somewhat flexible cash flow. That goes back to what Ava talked about as far as the interfamily loans. I've set up loans in a number of different ways. Some have been interest only. Sometimes we set up, maybe the amortization is over a 9, or, well, if you want to use the midterm rate, it has to be a 9-year term. But maybe we know they're going to have, or expect them to have, cash flow over a longer period to make faster no payments. So we've maybe set up a 9-year amortization, but expected to pay the note off in 7, and that's actually the payments that they're making. Maybe you set it up as a 20-year amortization so that the payments are lower, and then have a balloon in year 9. Again, anticipating that you're going to pay it off in 9 years, but if the cash flow isn't there to pay it off, you can, use that lower term. For this technique, you do not need to survive. The donor does not need to survive the term to get the benefit of it. If a person dies with the note, then that note is part of your gross estate. This technique can be used for income tax or for generation skipping purposes. So ultimately it can benefit grandchildren. And then again, the grantor is going to pay the income tax. And I have clients that definitely don't like that part of it, that they have to pay the income tax, say on the S Corp income that's in the trust. But there is an estate tax advantage of doing that, in that the payment of that income tax liability is not treated as a gift for gift tax purposes. And so, I have clients that have transferred a lot of wealth to the next generation just by paying their income tax liability. The one thing as far as a disadvantage is that this is not statutory. It's a technique that uses a number of different tax provisions. It's mainly successful because there's currently a disconnect between the income tax rules and the estate tax rules, in that the trust is out of the estate for estate tax purposes, but part of the estate for income tax purposes. There have been proposals in Congress over the years to take out that disconnect, and so that is something that we'll need to watch for in the future. The other technique that we've talked about in the past, and that is still very popular, but may not work as well today if you're looking at using your lifetime exemption, is the GRAT. And this is really a freeze technique, in that, you're transferring an asset to the grantor trust again in exchange for an annuity. Generally, the annuity is going to be structured so that the present value of the annuity payments equals the value of the assets going in. So there's no gift element. The benefit to the children is whatever the growth in that asset is. You know, right now the IRS is assuming that that asset is going to grow at a rate of 0.4%. That's the rate that we need to use in calculating this. So if that, let's say it's an S Corp, that S Corp goes into the trust and is growing at 10%, all of that growth over the 0.4% is going to drop to the children ultimately without any estate tax cost. So this again is really a freeze technique. Why I'm not looking at using it as much right now is because there is no gift element. And so again, if you're wanting to use your exemption, this is probably not the technique to use. That is one of the advantages. You know, if we weren't where we are today, the GRAT makes a lot of sense because of that no gift element. Again, you want to try and you know, if you're using business entities, we want to, and this is for any of the techniques, try to have them be an interest that we can take discounts on for lack of control, lack of marketability. So typically you're not going to be giving a, you know, a control interest in an entity through these techniques. You're going to want to give non-voting stock or a minority interest in an entity. Some of the risks that, or the disadvantages, I guess, of this technique are, one, if the grantor dies during the term of the GRAT, then most of the time, 100% of that asset in the trust is going to be brought back into the estate. So this is one where you want to structure it so that you're pretty sure the person is going to survive that GRAT term. Another disadvantage of this technique over either the SLAT or the sale to the grantor trust is that this is not a good vehicle for doing generation skipping planning, in that you can't allocate the GST exemption until the end of the GRAT term. So let's say you put, you know, $1 million of stock into a trust. At the end of the GRAT term, because of the growth, it's now $5 million. You would only be able to allocate exemption at the end, like I said, and so that's the $5 million value. And so sometimes that works, but sometimes it doesn't. So again, if you're really wanting to do generation planning, this is probably not the technique to use. Another disadvantage or another complication maybe with the GRAT is that the annuity payments are set amounts. You don't have the ability, the flexibility with the no payments like you do with the sale to the trust. And so if you have a company that isn't going to necessarily have you know, regular cash flow, regular distributions, the GRAT may not be the right technique. If you do use the GRAT and the asset or the cash is not there to make the GRAT payment, then you have to issue back assets of the trust to make that GRAT payment. And so at that point, you do need to get a valuation of that stock every time you're doing a distribution back. And you do want to make sure that, you know, the payments are being tracked and being paid on a timely basis, because you need this to operate as it's set up to operate. With all of these transactions, they would be reported on a gift tax return, whether or not there is a gift element. So for example, with the GRAT, again, we don't have a taxable gift, but we still recommend reporting that on a gift tax return just to have a statute running on the valuation so that the IRS can't come back later and say, well, your value wasn't really $1 million, it was $2 million, and so there was a gift element. And the same applies with the sale to the defective trust. We want to report the sale in addition to the gift. Just a couple things on defined value clauses. Ava mentioned this earlier. The key thing with this is that you're defining what the value is that you're transferring, not the assets that you're transferring. So again, you're transferring $5 million of ABC stock. And a lot of times the agreements will say if you have the valuation that's initially determined to be X number of shares. This is a great tool if you're doing a hard to value asset and you know you only have $5 million of your exemption left. Then you can say, I'm going to gift $5 million and the number of shares can be determined later. There are different rules on, or different thoughts on how that is interpreted. Some of those examples are listed here. The case that's mentioned, the intent, I think, was clear on what they wanted to have happen, but the language that was in the assignment was not clear as far as that it was a $5 million based on a value finally determined for federal, estate, and gift tax purposes. And by not having that language in there, the formula didn't work. Just a couple things. I see I only have a couple minutes left. Secure Act made some significant changes for distributions from retirement plans. And since this is an estate planning session, I'm going to talk about it from an estate standpoint. The thing that changed, the biggest change, and this has been coming for a few years actually, is that in the past, a beneficiary could take distributions out of an IRA over their life expectancy. So if you had a grandchild as a beneficiary and that grandchild was age 20, maybe they're taking it out over a 50-year window. The rule has changed starting this year that there is now a 10-year window for taking these IRA distributions or liquidating these IRAs. There's no annual required minimum distribution during that 10-year window, so it's not like you are required to take a 1/10 of it out every year. It's just by the end of that 10th year, you need to take out 100%. Couple things with this is, one, I had a client just pass away in the past couple months with a large retirement plan, fairly young children. They had set up a trust that was set to work, with it being over life expectancy. Now we're looking at the kids having to take this out in 10 years. There's a lot of income tax planning to do, making sure you're taking best advantage of the lower tax brackets. Planning how you want to take that out over the 10 years. And then if it is payable to trusts, maybe the intent was that that annual required distribution over lifetime was required to come out of the trust, but parents weren't looking at large sums coming out of the trust. Now, if those required distributions are required to be distributed every year out of the trust, these kids could be getting larger distributions. So if you have trust set up to take advantage of some of these rules for your post-death IRA distributions, you probably want to go back and look at those and just make sure that they're still going to make sense, as much from an income tax standpoint, but as well from a family goal and your distribution planning standpoint. There also are provisions that you can take IRA distributions out if you have been affected by COVID, primarily diagnosed with COVID and had unexpected expenses, let's say, not able to work, that kind of thing. There's $100,000 that you can take out that won't be taxable this year with no penalty, but then you can elect to treat that income as taxable over 3 years, or you have the ability to put it back in to the IRA. And lastly, the other thing that changed in the CARES Act affects charitable contributions. Basically, there's good, in the past, charitable contributions were only deductible if you actually itemized your deductions. For this year, there's going to be a $300 above the line deduction for charitable contributions. So even if you don't itemize, you'll have a $300 deduction. Not clear at this point if that's doubled for married couples. The other thing is that for cash contributions to public charities, not to donor advised funds, but to outright public charities, there's no limitation on how much of your AGI you can give. So under prior rules, after tax reform a couple years ago, there was a 60% limitation for this type of gift. And now for this year only, there's 100% of AGI that you can gift. But again, it's cash gifts and not to donor advised funds. So to wrap up, you know, we've covered a lot of information in an hour. What do we know from all of this? What we can do is plan for the laws that we know today, but also keep in mind what the future changes might be. And as we've talked about, this is kind of a critical time to really be aware of what those potential changes might be, and that they might change sooner than we have anticipated in the past. So start those conversations now if you are interested in using your exemption particularly. And the other thing is that because of all these potential changes and not really knowing what's going to happen, we want to build as much flexibility into the plan as we can, so that your plan can work even if things unexpectedly change. I don't see any questions in the Q&A, but if anybody has any to put in there, please do so. Ava and I'll stay on here for a couple minutes. And then also, I think at the very beginning, you have our contact information, or contact your client advisor, you know, your Eide Bailey person, and we'd be happy to answer questions in the future.
How does this sort of estate planning work for someone who is divorced? I also saw one in the chat that was for if they were, if they're single with no kids as well.
As far as estate planning for someone who is divorced or doesn't have a spouse, doesn't have kids, the only technique, so let's say you don't have a spouse, but you do have children that you want to benefit from that, the sale to the defective trust and the GRAT still work very well for transferring assets to the next generation. The spousal lifetime access trust is really the only technique that obviously you need a spouse. So the other techniques would work very well. You know, if you don't have family members that you want to be beneficiaries, then, you know, building charity into the plan is an option, or, you know, the plan could, you can still use the same techniques. It's just maybe family that aren't the ultimate beneficiaries. Question on IRA should have trust versus children as beneficiaries. That is not an easy question to answer right now with these new rule changes. You know, there's definitely situations where you want the trust, where you need the trust from a family dynamic standpoint. And then you just need to structure the trust in a way that you can save as much as you can on the income tax side. You know, we've had situations, I think I had questions on one where there was a special needs person, a special needs child that was going to have a trust, and then another child. Well, we looked at it, and it really, because of the nature of a special needs trust, you really don't want IRA income going into that trust, because it's going to be taxed at a very high rate for income tax purposes. So looking at the plan, rather than splitting the IRA between the two kids, more of the IRA goes to the child that is going to receive the income, can pay tax, hopefully at lower rates than the trust that's going to receive it. There's just going to be special drafting, and I think we're still figuring out, actually, even though the law has been in place for about 9 months, still figuring out how that looks. So there's a question on gift given today when there is no limit. What happens if more is given than is allowed under new tax laws? I'm assuming that's referring to the gift tax rules. And as Ava talked about, you know, if you give the $11 million today, and then the exemption drops to $6 million, that difference of $5 million under current law is not going to be subject to estate tax later. Yes, donation to a church qualifies for the $300 above the line deduction. There, a question on special needs trusts, can the transfer go to charity when the beneficiary dies? And yes, you can set that up however you want as far as where the assets go after death. The thing with having the charity there is you're probably not getting any charitable deductions, but it can definitely go there. Ava, did I miss any questions?
Nope, you covered them all. There was one question I answered while you were speaking that was a question about stepped up tax basis for a home. If you have a personal residence and you die with that home in your estate, that home would get a stepped up tax basis for whoever receives the home. If your home is owned jointly, let's say between husband and wife, there's a stepped up tax basis in just half the property, whatever portion the decedent owns. Other than that, Ramona, I think we have answered all the questions.
Okay. Well, thank you everybody for attending.
Yes, thank you, everybody, and thanks for participating, and we will all see you around again.